Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey. In the last episode, we covered manipulation, and one of the best ways to protect yourself from that is through risk management. Risk management is about deciding how much of your portfolio an idea deserves, how long you're willing to wait, and what it would take to let go of that idea. A lot of investors think about risk too late. They find an idea they like, buy it, and only get serious about risk when the position moves against them. But by then, most of the important decisions have already been made. The real risk decision happened earlier when they chose the size, the time frame, and the amount of uncertainty they are willing to carry. That's why risk management starts with portfolio weight. The same company can be manageable at 2% of your portfolio and a real problem at 20%. The business didn't change, your exposure did. And in practice, that's what risk management usually is, asking how much power you're giving that idea over your portfolio. A useful way to manage that is with a tiered position framework. Instead of giving every idea a full-size commitment on day one, you let positions earn more weight over time. The simplest version has 4 stages: starter, builder, core, and trim or exit zone. A starter position is your first layer. It's small enough that you can be early without doing real damage, but large enough that you care and keep doing the work. That matters because early in a thesis, uncertainty is still high. Maybe valuation looks attractive, but timing is unclear. Maybe the business is improving, but the market hasn't recognized it yet. A starter position lets you participate without giving the idea too much control too early. That's important because a lot of portfolio pain comes from sizing full conviction before full evidence. People don't just overestimate the quality of an idea, they overestimate how quickly it's going to work and how well they'll handle volatility while waiting. Then comes the builder stage. This is where you add, but only under specific conditions. You don't average in just because the stock is down. You add when valuation improves and the original case is intact, or when the thesis itself is getting stronger and the position still deserves more weight. You build because the opportunity improved, not because price fell or your ego got involved. That's a valuable distinction. Averaging in can be smart. Averaging down blindly usually isn't. If the business is weakening, capital allocation is getting worse, or the reason you bought is starting to break, buying more at a lower price doesn't make you disciplined. It just gives you more exposure to a weaker thesis. Time frame matters too. Every investment thesis has some kind of unlock. Maybe it's a near-term catalyst. Maybe it's a few quarters of improved results. Maybe it's a longer compounding story that needs years. Whatever it is, the time frame should come from the mechanism you believe will close the gap between price and value. If the unlock is vague, the starting size should probably be smaller. Patience is useful, undefined waiting isn't. That's why a core position should be earned, not assumed. A core position is where meaningful capital sits. You get there because the thesis is strong, the valuation is still attractive, and you're willing to let that idea matter. But even then, size shouldn't be driven by excitement alone. It should reflect how proven the case is, how much uncertainty still exists, and how much of your portfolio you're comfortable tying to that outcome. And that's where concentration gets serious. Concentration isn't automatically bad. Some of the best investors in the world have been concentrated. But it only works when it's chosen deliberately and monitored honestly. It's helpful to have a maximum intended weight. Every investor needs a limit somewhere. That ceiling forces a useful question. Is this position bigger because the thesis improved or because success made me less careful? And that leads to trimming. A lot of people struggle here because trimming sounds like losing faith. But trimming isn't necessarily bearish. It's risk control. If a position has grown well beyond its intended size, if valuation now looks full, or if the future upside no longer justifies the portfolio weight, trimming makes sense. You're not saying the idea is bad. You're saying the size is now doing more work than the thesis. Which brings us to the exit decision. For a longer-term investor, price noise alone usually shouldn't be enough. Volatility is part of the deal, but there still has to be a line somewhere. You exit when the thesis breaks, when management changes the quality of the story, when capital allocation weakens the case, when the expected catalyst meaningfully fails, or when too much time passes without the reason for owning it playing out. Here's a simple test you can use. Just ask yourself, would you initiate this position fresh at this size today. So the framework is pretty straightforward. Start with the measured position. Only add if the price improves with the thesis intact or if the thesis itself gets stronger. Let core positions be earned. Set a ceiling so success doesn't quietly become concentration risk. Trim when size or valuation gets ahead of the original case. Exit when the thesis breaks or the timeline doesn't make sense anymore. What makes this framework useful is that it respects uncertainty. It doesn't assume you'll nail the perfect entry or know exactly when the market will agree with you. It gives you a way to stay patient without becoming passive and convicted without becoming reckless. When it's all said and done, it's not your best idea that defines you. It's how you manage your worst one. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.